It's very easy to look at these indexes and get very discouraged. 2022 has not been fun. Many of you, like myself, have lost a lot of money throughout the year investing into great companies, but have frankly gone down in share price. The NASDAQ, currently down 33% on the year. It's not very often you see a NASDAQ perform that bad in one calendar year. The Russell 2000 down 22%. The Dow, the best performer, only down 8.5%, and then the S&P down 19.77%, about a whole 20% down just in the year 2022. And it's very easy to look at that and get discouraged because my portfolio, which currently sits at $35,000 and change, could be a lot higher if this year would have been a lot better. And the companies that I own, some of them performed great, some of them performed terrible, some exceeded my expectations, some fell way below it, and 2022 has been a rough one. We're going to talk in this video about tax loss harvesting, how this one negative outcome in the year of 2022 can be flipped as a positive, and how you could use this strategy now before it's too late. Because right now as I'm filming, it's December 26, 2022. There's only a few days left in the calendar year. In fact, there's only 4 trading days. Tuesday, Wednesday, Thursday, Friday, and then that's it. This opportunity is gone throughout the rest of the year. You have to wait a full calendar year to use this opportunity again when you can write it off on your tax loss harvesting strategy. So we're going to talk in this video the basics of what it is, how I might be using it with my portfolio, because if you look right now, my holdings tab currently looks like this, and some of them I'm up big on, some of them I'm down a lot on. So let's go ahead and get started. Let's look into these type of opportunities and how you can maybe implement this into your own investing portfolio. But before we get into all that, we have to talk about today's sponsor, MooMoo. MooMoo is a new up-and-coming brokerage that is taking the world by storm. Commission-free trading, level 2 data, advanced technical indicators, earnings calendars to see the date of financial statement releases, and institutional tracking to follow Warren Buffett's portfolio are just a few examples of what MooMoo has to offer. With this being my first sponsor in the channel, I have fully vetted their company and stand behind their vision. MooMoo currently trades on the NASDAQ under ticker symbol FUTU for FUTU and is SIPC insured. If you sign up below using my special referral link, you can get anywhere from 1, 10, or even as high as 20 stocks for signing up when you use my special referral link down below in the description or in the pinned comment down below. Free stock amounts can be as high as $1,000, so sign up now using the link in the description or pinned comment down below. You would help support me and my channel by doing so and give yourself an edge in the world of investing. Thank you so much, MooMoo, for sponsoring this video. Now back to the content. Tax loss harvesting is a strategy to lower current taxes paid to the U.S. federal government by deliberately selling an investment at a loss, i.e. deliberately taking a capital loss, in order to use that loss to offset taxes owed on an investment sold at a profit, i.e. capital gain, or even taxes owed on personal income. The investment can be any tradable security, stocks, bonds, shares in an ETF, exchange traded fund, or even cryptocurrencies. Tax loss harvesting is relevant only for taxable investment accounts, and the benefit is tax deferral, not tax cancellation. So first off, your investment account. If you're looking at all your holdings, the companies that you own across the board, if you're looking at this in a 401k, if you're looking at this in an IRA, you're not getting taxed anyway because you're just waiting for retirement, so you can go ahead and turn off the video. This doesn't apply to you. But many of you have taxable investing accounts, which is what I have, which means anytime you buy and sell securities, you're going to get taxed or get tax reductions off the gains or losses that you have. So a super simple example is that you can sell an investment that's underperforming and losing money, like right here. And then you use that loss to reduce your taxable gains and potentially offset up to $3,000 of your ordinary income. So for example, Crocs is up currently about $6,000 or so because I have a cost basis of 76, and I think today it trades in the low like 100s. I think it's like 103 or something like that it traded at. Let's see, yeah, $103. So right now I have about $6,000 or so worth of gains. I could take those gains, or I could sell out of a company that I'm losing money in. For example, CRM, my average cost basis is around 180, and that is significantly higher than where we're sitting at today, which by the way, CRM is my large position and currently trades at 130. I could then sell $6,000 worth of losses on Salesforce and essentially net out my taxable gains and get a 0-0 net of $0 where I wouldn't have to pay any taxes, I wouldn't owe anything. Additionally, if you wanted to do another alternative, if you didn't want to do any of that, if you don't have any gainers this year, pretend that you only have losses. So for example, another company that I'm down on out of the 4, Amazon, is down, and I have an average cost basis on this one at around 115. Now, Amazon right now trades at $85, and with me holding about 200 shares of this company, that means my losses right now are unrealized at about $6,000. If I wanted, I could sell half my position, take a $3,000 loss, and use that as a tax write-off against my taxes so that way I could benefit from this company going down in share price. Because if you look at all 4 companies I own, it is pretty sad to see how bad 2022 ended out. And this is with me lowering my cost basis on many of these. So I bought my shares in CRM at around 180 average share price. In the last year, it is down 50%. If we go next in order, let's go ahead and look at Amazon like we were just talking about. My average cost basis on this is around 115, and in the last year, the company's down exactly 50%, just like CRM. What about Crocs? This is one of the only winners this year. Actually, out of the 4 that we're talking about today, this is the only winner. It is down 19% within the last year, but I didn't enter into this position until it was far lower because 1 year ago it was at 127. I bought my shares at 76. So we're doing quite nice on this one. This currently is up about 35% or so from where I bought at, but this is the only winner out of the 4 because finally we have Google, which my amazing cost basis at $90 a share, well, we're basically break even. We're down like 1%. I think it's $90.30 if I'm remembering correctly is what I'm down on Google. But even in the last year, Google stock, one of the best companies on the planet, is still down 39% in the last year, and it's given away a lot of its multi-year gains. And you can say that across the board about all of these companies because Amazon, if you see right now, it is trading pretty much where it was at pre-pandemic lows. The lows in 2020, which you can see right here, was around $83, $84. Today, we're at that price at 85 bucks. If you look at Google, you can see that Google is doing significantly better, but if you look at Salesforce, it is doing pretty much the same thing as Amazon. It's trading at pre-pandemic lows, and the only benefit of that with this company trading at the lows of around 125, 130, which is right back where the pre-pandemic losses were, you can take a benefit of these tax reductions. So there's 2 main things you could be doing right now while you have 4 trading days left in the year. You can use any winners that you have, sell them and take some profits off the table, actually book them so that way you'll get taxed on them, and then sell some of your losers to offset that losses. So if you have a winner that has $5,000, you can sell a loser that's about $5,000 in losses and net out your taxes. Additionally, you can take an additional $3,000 of tax write-offs, and if you go over this, keep in mind it will roll over to the next year. So pretend you only have losses. Pretend your net you have $10,000 worth of taxable losses. You can roll over that $3,000 of tax write-offs into next year's and you'll have $7,000 that will carry over. I've used this before because there was 1 year in 2019 where I had over $3,000 in losses and it carried over into 2020 when I had a lot of profits. Last year I think I had $11,000 in taxable gains, and this year I'm going to have break even pretty much. But you can see we have profits of $1,757, and that's probably where we're going to end at for the year. I know I have some covered calls that expire this week, but that's pretty much where we're at. So overall, guys, use this as an opportunity to lower your taxable events, not increase them. It's never fun to watch your investments go down in value. Trust me, it's not fun watching all 4 of these companies go down, but pretty much other than my Crocs position, everything has gone down, and that's across the board for most investments. Pretty much anything that's not investments into the energy sector or some type of blue chip dividend stock that did very well in this recessionary environment, pretty much across the board is down. So use this as an opportunity to lower your tax bill and give yourself an edge up in the world of investing. Thank you guys so much for watching. Check out all the stuff down below in the description. Thank you MooMoo for sponsoring this video, and I'll talk to you guys next time.